Hello, how are you doing? Are you well?
I'm good, thank you. How are you?
Yeah, I'm good. Monday though, isn't it? It's always why are Mondays always so difficult? You had
At
your
least it's Monday afternoon.
oh, you got your little baby to get organised today as well, haven't you? So
I have. He's out of the house now, so that's one plus when you're doing a podcast.
yeah, at least it won't be crying that you have to run off to. Oh, well, it's great to see you, and I'm really glad you joined us today. And I'm really pleased with doing this topic because obviously we're currently selling my partner's business, which is why I'm grayer. Like that I before. I just can't believe how long this has all been going on for. It really goes on much longer than you think it's going to. But I mean, one of the things that was interesting is we kind of dived into it, but there wasn't really very much preparation for this. Do you think as a professional in this it's important to prepare sort of specifically for sale?
Yeah, absolutely. Yes, I think we use the metaphor of selling a house to help people understand the context of the services that we provide. And you wouldn't start the process of selling your house without, at least considering tidying up, making it more attractive to a buyer, would you? So I think in a business, preparing specifically for sale, it's so crucial. It's so crucial you want to maximize value. That's the bit that everybody gets. But it's also so crucial to minimize disruption. And I think that's the piece that if you've not been through a sales process before, you might underestimate. So, buyers are going to scrutinize every aspect of your business, and being sales ready means you've anticipated their questions and you've addressed all those potential concerns.
Yeah, I think I mean, that just from our experience, I would say that's true. Because a lot of them were sort of answered as we went along because they came out of nowhere. It was none of it had been prepared. So the amount of work was like it's just huge. It really is huge. Would you say that? Because I mean, we had to do it as we went along, but do you think that the normal checks and balances that you would do as a business owner are enough for a buyer in terms of management accounts? What and for them to buy, or do you feel there's something more that you could do for buyers when they're coming in?
I think management accounts are a great starting point, especially if they're prepared monthly. And they form the basis of our analysis, but they're rarely enough on their own. So I think in extreme scenarios, the management accounts and the board pack, if you like, on a monthly basis of one business, it might have a really detailed P&L. It might have lots of additional detail on trading, like revenue streams, margin by revenue stream. Might have lots of consideration of trend analysis. It might have lots of narrative, which talks about the context, of the business and the wider sector. That's absolutely a great starting point for sale. But then at the other end of the spectrum, we've seen sizable businesses, they're attracting a lot of interest from potential investors, and they don't produce monthly management accounts, or
That I
you
believe.
know,
That I
yes.
believe.
And even when they do, I mean, the revenue recognition policies can be wrong. There might be cash accounting, it might be inconsistent, constantly changing, and obviously that level of detail just isn't sufficient, for a sales process. So, and the thing is, that's the scenario normally when you've got a really profitable business that's just been, it's been run, it's known and managed business. They know they're kind of looking at the bank account and running it from that perspective, which is great. And it means that you didn't need to produce this additional data, obviously, because it just hadn't been a requirement. So I'd say 90% of scenarios, business as usual management accounts are a great starting point, but they typically always need some kind of improvement or some supporting data, to give a buyer or an investor the level of comfort that they need.
Yeah, so that it isn't just the founder sort of check it, as you say, checking the bank account all the time. I'm glad to say neither
Yeah.
of us are like that.
Well, you know your business. That's the thing, isn't it? I think if you're an
Yeah.
owner and you know your business inside out, you don't necessarily need it. But then you obviously understand that a buyer doesn't know anything about your business, so they start from the ground up.
Yeah, it's also too much to hold in your head, I find. So my head
Yeah,
starts to implode quite rapidly. So
that's why we love spreadsheets.
from your experience, what are the financial areas that a buyer really focuses on first? What are the things that they sort of go, right, I need to see this and this?
I would say typically the quality of earnings, so the true cash generation of the business. They will focus on the working capital profile of the business, so how much cash is tied up in that working capital profile. They will focus on debt-like items because that will affect the deal metric, the amount that's ultimately paid for the business. Um, they want to know how sustainable profits are and how cash moves through the business. So any anomalies like, one-off adjustments or any inconsistencies in margins and things like that, that'll all, be questioned and need to be kind of understood. And I think certain buyer pools, particularly private equity investors, they'll be very focused on the growth potential of the business. So it's the responsibility of the vendors and the management team to explain how the financial forecasts that will probably be driving the value of that business, how that can be achieved. And obviously, preparing for that means clear documentation, supporting documentation, which reconciles, that's a big thing. And just a strong understanding, as a business owner, what the financial drivers of your business are.
Yeah, which I know some of the business owners that I know really don't pay enough attention to that. I think it's because it's less of my sort of area, as it were. Technically, I'm a writer, so I really focus on the financials because I know they're not my best bit. But I think I've seen so many other people that really don't understand that at all because they're just doing the job. So how would you suggest that people can really improve their reporting for sale and make it more robust? So obviously the buyer's looking for all those different things. So how do they start as an owner improving all the information?
So we do this, just to go back to the house analogy quickly. There's different processes if you're selling your business. There is going down the formal vendor due diligence route, which is basically the sales process is live. The business is ready for sale and everybody's interested. And you get a business like mine, my team, to come in and produce this report basically that ultimately buyers can rely on. Right. So in that scenario, if using the house analogy, there's a stain on the carpet, we're completely independent. Everybody has to see that. Whereas there is a piece of work that can be done before this kind of formal report, which we call vendor assistance. So that's where we're going into businesses and we become a bit of an extension of the finance team or the management team, if you like. And that's where we're effectively the cleaners. So in this scenario, if we see the stain on the carpet, we get the foam out and we spray it and we get rid of it. So I think it's all about, first of all, it's understanding where you are in the process and what you can do depending where you are in the process. So I say, how can you improve for sale? Solid monthly reporting is a great foundation. Focus on consistency. We see so many businesses where they change the format of the management accounts. That's a nightmare. You just want some consistency across, a 2-3+ year period, so people can actually get under the skin of the numbers and understand the business. Clarity where possible, just keep it simple, keep it understandable, don't overcomplicate things. If you can, segment things like your revenue streams, highlight any recurring income, that you've got in your business. Buyers absolutely love that. Ensure that, any KPIs, so whatever means you have of tracking your business, ensure that they're, it's very obvious what these are, they're well defined and they're well tracked. And yeah, I guess as a business owner yourself, try and identify what you would think would be any kind of gaps in terms of how information is presented, because ultimately the objective is have the business story ready, make it easy for buyers to understand that story and then to believe it.
Yeah, but there must be some really common mistakes that everybody makes. I mean, I'm sure we've made some real clangers that a finance person, like in your own sort of background, would have come in and gone, that should have been done first. But what are the common mistakes that people make?
So yeah, definitely. I think the most common one, and you alluded to it, the most common one is not understanding the time and effort that's required in going through a diligence process. And the diligence process, the investigation piece, the survey piece, if you like, is only a small part, of the overall sales process. So people massively underestimate just how much time, it takes to get a business sold. And I appreciate that. I would say this, I'm an advisor, but people don't get advisors at the right time, or they don't get advice. And just a really quick example, at the risk of getting just a little bit too technical in one part of this. So a few years ago, I worked for, it was a big corporate pub chain. So they were huge. They were buying smaller kind of pub restaurant businesses. And one particular transaction, they were buying, I think the deal was about £5 million deal. So it wasn't huge, but they were buying 3 or 4 pub restaurants off two men. And it was quite a sad scenario because one, I think, was kind of quite chronically ill, which is the reason for the sale. So you've got huge corporate acquirer on the one side, and then you've got, the owner managed business entrepreneurs on the other. And they didn't have any advisors, even though they're up against this big corporate beast. There were no advisors in play. And the first thing that got agreed was a heads of terms on how the deal's structured. And basically, they set what they call a net working capital peg. It just got set at zero. That's the way we do it. That's what's happening. Whereas in this kind of industry and sector, basically, at any one time, this net working capital is flowing at minus 700 grand. So if anyone listens to this podcast that has absolutely no idea what I'm talking about and what nonsense has just come out of my mouth, what that means in simple terms is the vendor's lost 700 grand, and that was before the diligence team even stepped on site.
Just
because that,
just agreeing something that they didn't know not to agree to.
Just by signing a document that to them, they didn't know that wasn't just standard black and white, and it's reeled out every time. Whereas to an advisor, that's the absolute bread and butter, and that's the point, isn't it? I think you don't know what you don't know. So experts seem expensive, but we've not charged 700 grand yet.
Yeah, for that one piece of advice. Yeah,
exactly.
Really good example. Yeah, and here's my invoice.
I wish, if only.
So you said that that you work with the internal team sometimes, in sort of that preparation piece. So what's the balance between internal and external team? Because I guess a lot of the internal team will say, "Oh, we can manage it. We can prepare for this sale. We've got all the expertise that we need." So what's the balance between the two sides?
I think it's a combination of both. The extent to which it's more internal or external obviously depends on the finance team and their skill set, and the resource that they've got available. But yeah, it's definitely a combination, because the internal team, they know the business. And even if the external team, the team of specialists like my team, we might know a business like that business, but we don't know your business. So I think in a perfect scenario, the internal team bring that knowledge, and the true grains of what the business is about, and the external team bring, objectivity, experience, technical expertise. So yeah, we do exactly that. We do this vendor assistance piece, and our role is to kind of to challenge, to refine, and also to create that timeline to meet buyer expectations. So the best outcome, comes when both sides know what they're working to and when. Because again, I'm sure, as you're aware, you can just get so bogged down into one thing, then days, weeks have passed, and it just feels like an endless slog that's not actually getting to the point you want it to get it to.
Yeah, and I think that is very true. You can feel a lot of time's passed and there's been no movement, and it's deeply frustrating. So I was very aware that the finance team were under a lot of pressure, that like producing all the figures and on top of running the day-to-day work. So what can you recommend to help finance team members sort of going up to a sale? And it's an insecure time for them as well, isn't it? Because you're not quite sure what's going to happen after the sale, are you?
No, exactly. I think it's a common challenge. I mean, especially in smaller businesses, obviously, that naturally have smaller finance team. My first advice is don't book a holiday, because everybody in the finance team books a holiday when they're about to go through a transaction. I can't say I blame them, but you're still going to come back to it. So don't book that holiday just yet. Bring in support early. So don't wait until the process is live. We see this so often. Do some form, and I don't. It doesn't need to be a Volzo. It doesn't need to be in exactly the format we do it, but do some form of kind of vendor assistance preparation. So it's making sure that the documentation is prepared, that it's ready. It helps to set, like I say, these realistic timeframes, and everyone's got clear guidance on where we're going and why. And that's the thing. The last thing you want to do in the middle of a live process is for the trading of the business to slip, because the bandwidth of key individuals is being sucked into preparing documents for the finance or the legal due diligence, and we see that so often, and it can end up in a pens down scenario. And all that's doing is just incurring more professional costs and time and fees and calls. And everybody gets deal fatigued, so much quicker. So it's all about preparation. And it's, you might feel like you've over prepared, but then the process will be so much more seamless than if you haven't.
I can imagine. And then you get to the point where the deal's gone through and you have to sort of integrate everything and the businesses together. And obviously everyone's probably exhausted as well from the sale. So it just never stops, does it? You go from one problem to the next. So it's sort of the integration. What would you suggest would really help in approaching that integration aspect? Is there anything that could be done beforehand that can help you move into that?
Yeah, I think it's a really good point. I think integration is so often overlooked, but obviously it's so critical to long-term success of the merged or, the merged acquired businesses. But yeah, it's exactly that. People are so deal fatigued, aren't they, by that point? I think it's the same point. I think you start planning early. So obviously you can't integrate before the deal completes, but you can ideally before the deal completes understand what systems, what processes, what people might be affected by the integration piece, and you could maybe start to identify certain friction points and things that you expect, and you can start to think of ways to mitigate that. From a financial perspective, again, it's having clean, well-structured data means that integration piece is going to be much smoother. And yeah, you need that financial foundation. It's just so much easier to transition into the integration of the new system post sale.
So it's actually identifying those problems right up front that you can foresee. So sort of having a couple of people just working on that, really, while the rest of you working on the sale would be worthwhile, wouldn't it? And is that something that professional advisors help with as well, or is that something that you sort of envisage the internal team doing, particularly with the finance?
Again, a bit of both. So I think certainly professional advisors working in this space have realised more and more that these problems are, pretty common, and you can get businesses that are so acquisitive that they're slamming on bolt-on businesses constantly, and then it's quite a common problem. I think that suddenly someone needs to sit down and go, hang on a minute, we just need to seamlessly integrate all this, because it's kind of snowballing into what's potentially a bigger problem down the line. So yes, professional advisors now, a lot of professional advisors have specialist teams that can help with the integration process.
That's really interesting. What's the kind of big problems that you've seen with integration in your experience?
I think it's exactly that. It's that people haven't envisaged. It sounds ridiculous, but what needs integrating before it is? So people haven't just, what needs to be done? And I think everyone's just kind of thought the absolute, the ultimate outcome here is get this deal done. And everything is so spearheaded towards get this deal done that, like you said, a pen hits the paper, everyone falls on the back and absolutely shattered. But then they've got to immediately get back up, and then it's day one of the new business. And I think by that point, then I'm saying don't take holidays during the process. So then everybody wants a break and needs to kind of refresh and recharge the batteries. But then it's so crucial that obviously straight away that integration piece happens, because if not, well, then there's wider problems of the things not being integrated and having two ways of doing things, and all the fun that goes with that. So yeah, it's preparation again. It all goes back to the same piece, but I think it's doing the pieces that you can before the deal completes, when everybody is still in that kind of traction zone of, we're all working towards something. It's highlighting those potential friction areas and working a plan that's kind of ready to be rolled out after transaction, not just started.
Yeah, so with the finance piece, what are the common problems you've seen within finance itself, the finance function, that haven't integrated well?
To be honest, we don't see a lot of that. So obviously we exit the process at the point when we've done our objective report. So this is the thing, and this is, I think, is the key point, that a lot of professional advisors, certainly those of us on the financial side, we don't actually see that. So I think from conversations, and I was talking to acquisitive businesses, it's having two or three different ways to do the same thing. And then it immediately moves so quickly past the finance function to be more of a cultural problem. And, things rapidly start to kind of progress from that point. So I think it's ensuring, like I say, when you're in that preparation process, do the systems kind of talk to each other quite nicely, which are going to transfer all the financial information, from Sage to another platform. Are there any, you can know there's going to be any integration issues before you press go on things like that. So I think it's identifying a clear roadmap of what needs to be integrated and how it's going to happen, and to ask whoever it is that's needed with the right skill set at each point of that to identify what potential issues could there be, and if so, what are the mitigations that we've kind of got in place? What can we do?
That's really interesting. I'm really intrigued by the fact that everybody stops using their advisor at the point that the deal happens, and yet actually you still need to get that integration piece done. Do you not think that people should hang on to their advisors to get that initial integration happening? That would seem quite obvious what you're saying.
Absolutely, yeah. And I think, well, we're getting a little bit more savvy in the advisor world of understanding that integration is such a big area, and there's so much advice that is probably needed there. That's currently, it's an underserved area as well. So I think, yeah, if I were a business owner, I would 100% be seeking out some kind of integration support and advice. I think it'd be absolutely worth its weight in gold, because it does exist, and it tends to exist as part of professional practices. But then also, I think there's quite a few niche offerings for different sectors that obviously you could do a bit of research on and find one that really fits well with your business.
That's really good advice. So what would your top tips be for any business that's like a business owner that's sitting there and thinking, eventually I want to sell? What would you say to them today?
Number one would have to be start preparing early. So I think ideally at least 12 to 24 months ahead of a potential sale, start planning. So get your, like I say, this get your books and records in order, have consistent information. The last thing you want, and we've seen it, is you go into a transaction and there'll be that many changes over the last 2 to 3 years that no one can get a grasp on what's actually gone on. You don't want that. That will rack up time and costs, and that's not the scenario you want to be in. So preparation as early as possible. Absolutely, again, I would say this: invest in vendor assistance, get the help of experts to clean up the financials, have the documentation basically ready on day one to hand over to someone when they want it. Because that seamless kind of 10-minute handover can be months and months and months of getting caught up trying to retrospectively create things that could have just been available. I would say understand your numbers. So again, it's not just churning out financial data, it's being able to talk to it. So especially things around underlying earnings. So obviously every piece of financial software can churn out a profit and loss account, but as the management team or the vendor of the business, be able to talk to what true underlying profits are with the one-off costs in there and things that need to be added back or considered in a different sense. So I think truly be able to talk to your business and understand it, and then support your finance team. They, you've just said it yourself there, they are key to a successful process. So they need to be supported. They need to be made sure that the bandwidth exists there to run the business, business as usual, and to support during a sale. And then, yeah, the integration piece would be my final point. Yeah, think beyond the deal, plan for integration and for future growth. Don't just assume that all the hard work ends, the day the deal completes. That's when it starts, really.
Yeah, you just sit back and go, well, it's your problem now, mate.
Yes, exactly. That's when our hard work ends.
You're on down the pub.
Yeah.
No, that's such great advice. Thank you so much. That's really useful. And if anyone wants to get hold of you, they can get hold of you through the Nexia website. So they'll be able to put you in touch. That's brilliant. Thank you. And I hope you have a good rest of the day.
Thank you. Thanks for having me, Rebecca.